What if you could invest in one fund that gives you exposure to dozens of high-quality companies, pays consistent dividends, and helps you build long-term wealth without spending hours researching individual stocks? That's exactly why the Schwab U.S. Dividend Equity ETF, better known as SCHD, has become one of the most popular ETFs among long-term investors. But does SCHD actually outperform the broader stock market? Is it better than simply buying an S&P 500 index fund? And should it have a place in your portfolio? In this video, we'll compare SCHD with the overall market, explain how it works, discuss its biggest advantages and disadvantages, and help you decide whether this ETF deserves a place in your long-term investment strategy. Before we begin, make sure to like this video, subscribe to the channel, and turn on notifications for more investing, ETF, and personal finance content. Now, let's get started. 1. What is SCHD? SCHD is an exchange-traded fund, or ETF, that invests in financially strong U.S. companies with a long history of paying dividends. Instead of buying one stock, buying SCHD gives you ownership in many established businesses across different industries. The companies included in the fund are selected based on factors such as dividend history, financial strength, cash flow, and overall business quality. This allows investors to diversify their money while focusing on companies that have consistently rewarded shareholders. 2. How SCHD is different from the overall market. A broad market ETF owns companies from almost every sector, including high-growth technology stocks, smaller businesses, and companies that don't pay dividends. SCHD follows a different strategy. It focuses mainly on mature businesses that have strong financial performance and a proven record of paying dividends. Because of this, SCHD usually has less exposure to speculative companies and more exposure to businesses with stable earnings and reliable cash flow. 3. The power of dividend investing. One of SCHD's biggest strengths is its focus on dividend-paying companies. Dividends are payments companies distribute to shareholders from their profits. Instead of spending these payments, many investors reinvest them to buy additional shares. Over time, those extra shares can generate even more dividends, creating the powerful effect of compound growth. This is one reason dividend investing has remained popular among long-term investors for decades. 4. Quality over hype. SCHD doesn't simply buy companies with the highest dividend yields. Instead, it looks for businesses with strong balance sheets, healthy cash flow, consistent earnings, and sustainable dividend payments. This helps avoid companies that may offer unusually high dividends but struggle financially. By focusing on quality instead of hype, SCHD aims to build a portfolio of companies that can continue rewarding investors over many years. 5. How SCHD performs against the market. Many investors compare SCHD with broad market funds like those tracking the S&P 500. During periods when dividend-paying companies perform well, SCHD has delivered competitive returns while also providing regular dividend income. However, during times when technology and other high-growth companies dominate the market, the broader market may outperform because it has greater exposure to those sectors. This doesn't necessarily make one investment better than the other, it simply reflects different investment strategies. 6. The benefits of diversification. Diversification is one of the most important principles in investing. Instead of depending on one or two companies, SCHD spreads your investment across many businesses. If one company performs poorly, the overall impact on the ETF is usually limited because other companies continue contributing to the portfolio. This makes SCHD less risky than investing in only a few individual dividend stocks. 7. The potential drawbacks. Although SCHD has many advantages, it isn't perfect. Since it focuses on established dividend-paying companies, it may miss some of the explosive growth that younger technology companies can deliver. During strong bull markets led by growth stocks, SCHD may underperform broader market funds. Investors should also remember that while dividends are generally reliable, they are never guaranteed. 8. Who should consider SCHD? SCHD may be a good choice for investors who want steady long-term growth combined with dividend income. It is especially attractive for people who prefer investing in financially stable companies instead of chasing speculative opportunities. Retirement investors often appreciate the regular income generated by dividends, while younger investors can benefit by reinvesting those dividends for long-term compound growth. 9. SCHD or the market. So which investment should you choose? A broad market ETF gives you exposure to almost every major sector, including high-growth companies. SCHD focuses on high-quality dividend-paying businesses with strong financial fundamentals. For many investors, the answer isn't choosing one over the other. Instead, they combine both strategies. A broad market ETF provides overall diversification, while SCHD adds dividend income and exposure to financially strong companies. This combination can create a more balanced investment portfolio. 10. Think long-term. The biggest mistake investors make is constantly switching between investments based on recent performance. Successful investors understand that building wealth takes time. Whether you choose SCHD, a broad market ETF, or both, consistency is more important than trying to predict which investment will perform best next year. Regular investing, patience, and allowing compound growth to work are often the biggest drivers of long-term success. SCHD has earned its reputation because it focuses on quality businesses, reliable dividends, and long-term investing. While it may not outperform the overall market every single year, it offers investors a disciplined approach centered on financially strong companies. The truth is that there is no perfect ETF. Every investment has strengths and weaknesses. The right choice depends on your financial goals, risk tolerance, and investment timeline. For many investors, SCHD can be an excellent core holding or a valuable addition to a diversified portfolio, especially if generating dividend income is one of your long-term goals. If you found this video helpful, don't forget to hit the like button, subscribe to the channel, and turn on notifications for more investing, ETF, and personal finance videos. Also, comment below, do you prefer SCHD or a broad market ETF like the S&P 500? Let us know your thoughts. Thanks for watching, and we'll see you in the next video.